in the case that there is. Like those are kind of the two things that you're betting on. There's a simple solution. I don't understand why they didn't do. Just write the checks for the people taking out the money. Post dated 6 years.
You got jokes, huh?
This podcast contains the arguably witty banter of two friends, Skippy and Doogles, that like to debate about investing. The content is intended to be entertaining and for informational purposes only, not investment advice. You should do your own research and consult a financial professional before using any of the information in this podcast, and especially before investing.
Genuinely, Doogles. Genuinely, how are you doing this week? I'm really concerned about you.
I'm good. In the face of tumultuous circumstances, only the strongest persevere.
You're just saying words. They don't mean anything.
Exactly. They don't mean anything. Let's just get into it. Please rate and review the podcast. We love it. We love it. Rate, review. Thank you for listening. Appreciate you all. And remember, if you ever want to ask a question, make a comment, etc., skippydoogles@gmail.com.
We know you're all craving that Silicon Valley Bank breakdown. It's coming to the end of the show. And it might be an epic rant for me, Doogles. I got some strong feelings about this. There is, oh my goodness, is there some quality journalism on this? There's a guy at netinterest.co that did a killer breakdown. The Wall Street Journal's just been crushing it. And breaking news, we're recording this Saturday morning. It looks like Circle USD, the crypto stablecoin, has some exposure to the Silicon Valley Bank stuff. And they're currently trading at 87 cents on the dollar. When this drops on Monday, who knows if they will still exist or not. Crazy times.
Whew. Oh man, this week was full of stuff, just full of it, with obviously what we're going to talk about there with Silicon Valley Bank being like the pinnacle. But to tell you how much this week was full of it, I'm going to start with something that has nothing to do with anything that we usually talk about. Fortune magazine. You familiar?
Oh yeah.
Fortune had an article this week about body doubling. And
of like pigs. What are we talking about?
We've gone, as a society, we've gone too far. So Twitch.
Yeah. Like not Ellen's DJ, but the other Twitch.
Yes.
Yeah.
RIP. The other Twitch, which is a service where people can go on and watch other people play video games. I've heard a bunch of folks be like, why would you want to watch people play video games? But it's very popular, very, very popular. Body doubling takes that to a whole new learn. That's level, in case you weren't clear. A whole new learn. Body doubling is where people go on TikTok and they make themselves live on TikTok and show themselves working. As an example.
Whoa. Do I get to see their screen? Like, is this a confidentiality concern?
It doesn't seem like it's a confidentiality concern, but I don't know. I don't know what all the situations are. I just read this one article, but one of the examples they provide in this article is about someone who's a data analyst. So when I first saw you get to see someone work, I was like, oh, maybe, like, I was thinking through a lot of different professions, which that could be real interesting. And data analyst wasn't one of them, but apparently, I mean, this person gets thousands of people that log on and watch them work for about 4 to 5 hours a day. And
what's the advantage to me? So I'm the guy doing work over here. I have to go buy a separate camera and like set it up so they can see me. And then do I get paid or something?
I mean, you make money. It's just like influencers. Like you become an influencer, right? Like that's the whole thing. This is another way that people become influencers.
But they can't even see like how I'm using an index match instead of a V lookup to blow Excel's mind. I mean, there's nothing. I don't get it.
What I'm telling you, okay, I didn't say I got it, first of all. What I'm telling you is this whole thing has gone to a whole new learn. The things that we will watch other human beings do is beyond. But I do believe that it is just like an influencer thing where you become an influencer. And this is another way in which you can engage fans, right, during the day. And so that's what's happening here. They got a picture on this article of the person drinking a Heineken while they're doing this too. Now, I can't quite, it's not high enough fidelity, the image, at least the where the Heineken is, for me to know if this is like one of those non-alcoholic Heinekens. or what, but does it matter in the end?
No, I don't think it matters because
So
that guy's an influencer, Doogles. He can do whatever he wants. He's not reporting to his company anymore. He's reporting to his viewers.
yeah. Anyway, I wanted to hit on that quickly. There's not a lot to say there, but when I read it, I just went, again, we're grasping, it seems like, for ways to entertain ourselves and entertain other people. And this, I'm not going to call it a low, right? Because I don't want to make judgment on it, but it's like, it's out there. It's out there.
Yeah. All right. Well, fascinating, I guess. There's more breaking news on the podcast. Mark Zuckerberg should have listened to Bill Gurley. Do you know why?
Go for it.
Meta is going to lay off roughly 13% more of their workforce over the next couple of months. Isn't that crazy? So one, Zuckerberg has seen the light. Remember just like 9 months ago when he was going to spend $30 billion on the metaverse, and he was basically hiring employees hand over fist and burning money. And now he's calling 2023 the year of efficiency. I'm happy about this as a shareholder, but wow.
A lot of people.
Yeah.
It's a lot of people. And it's like compounding and compounding. They're not the only company, right, that is having multiple layers of compounding layoffs, right?
Yeah, and this is where I don't know. I know the
You think they're
world
playing with
would have freaked
numbers?
out if they laid off 25% of their workforce whenever they did their first round. But
Or you're
like
saying from
that's
the get?
effectively where they're headed. And
No.
you know what that does to employee morale? Like, you ever been in
Bad.
one of those companies where you have a layoff every like 3 to 6 months? It's not a good
No.
place to work.
No. Oof.
All right, so let's dive into investing with a stat I found this week, and I really, really enjoy this sort of stuff. This is my call to action for Doogles and the long-term trend style. So there's some back testing, goes all the way back to 1926, talks about reinvested dividends accounting for 38% of total returns.
Mhm.
And here's the kicker, Doogles. It's higher than that during high inflationary periods. Like in the 70s, for example, dividend reinvestment represented 72% of stock performance. I haven't looked at this stat in a while, man. I mean, like, you see these, but right now, if you're, I don't want to speak too broadly here. Let's say it this way. I'm very happy that I own a lot of dividend stocks that I'm reinvesting consistently through this turmoil, because I know that's going to be a good thing long term.
Yeah, but yes. So do your thing. And the inflationary part of that, I didn't think that was particularly relevant. I think it was mostly reinvesting dividends during market downturns, which also overlaps with inflation. Like, it's not during inflationary periods.
That's a better way to say it. Yeah,
right?
Actually, that's a better way. And it's like, that's almost, they simplified something that's way more complex than that. It's like during inflationary periods, you're more likely to have a market downturn. In a market downturn, your reinvested dividends are more likely to be a larger portion of your total return in a positive sense. So yeah, I totally agree.
Yeah, I mean, it's a huge testament to the power of compounding in the utmost. Well, maybe if you combine compounding with being able to dollar cost average without your own money, although dividends in a way are part of your own money, but it's not quite, that clean.
Doesn't
I think
feel
it's
like it.
Yeah, it's really interesting. In this Twitter thread as well, Michael Mauboussin had a reply. I don't know if you saw it.
Yeah.
And Michael Mauboussin, the investor, Michael Mauboussin, we also talked about him last week. And Michael Mauboussin said, yes, and reminder to everyone that capital accumulation only occurs with price increases. So he wanted to be clear that it's not, the dividends are not the way that the investors end up making money by themselves. And he says that because, to use a simple example, if you have a company that's trading at $100 per share and it pays a $5 per share dividend, the share price is down $95. And so therefore, like, the price goes down. But if you reinvest that, then you have more capital that can then, if the price increases, that can then start to accumulate wealth. And so I just thought that was like an interesting ad by him. I don't know if I just overly complicated your situation.
No,
But
it makes sense. But also, like I thought you were going with a simpler yet related point. If the stock starts at $100 a share and goes to zero and you reinvested all those dividends over the course of 10 years, you wasted all that money, right? The rebound
yes,
has to come because
yes,
what
yes,
you're
yes.
saying is the price drops, you buy with dividend reinvestment or with dollar cost averaging. That's a very good point. This is why dollar cost averaging through market downturns is important. And then it actually rebounds. And that $5 that you bought when it was down in the 70s is worth $7 because it's up in the 120s now, right? Like that has to happen. So this is not just a blank mindless check of like, you still have to be
Yep,
smart
yep,
about your
yeah.
approach.
But love the point. Love the point nonetheless. I'm gonna dip in for another quick hit on Bill Ackman. Bill Ackman has an investment firm, Pershing Square, a very famous investor. And back in the first 18 months of COVID days, had what I'm coining the Ackman COVID trio. It will not stick. That name will not stick. But the Ackman COVID trio, there's a article in Vanity Fair that pulled an excerpt from a book that's coming out that touches on how a number of companies and organizations ended up either surviving or thriving during COVID, it seems like. But this piece, I'm just going to hit on the trio that Bill Ackman had. And Bill Ackman makes big moves. That's kind of how Bill Ackman, and some of them work out well. Most of them work out well enough, still is doing well. And he also has some misses, right? It's what happens when you make big moves. But here are three. So one is in early March of 2020. And if folks recall, February 19th of 2020 was the peak of the market. And then March like 16th was the trough of the market. And there was a 30 to 35% drop, something like that in between. So it was a really fast decline. Early March, Bill Ackman went to his organization and said, look, fellas and ladies, here's what we got to do. Either we are selling everything because I think this thing's about to crash hard, or we need a big hedge. And they went through their portfolio and said, what can we sell? What can we sell? They were debating some stuff and said, okay, we're not going to sell this stuff. We're not going to do it for a variety of reasons. So it's big hedge time. And so they ended up using credit default swaps. We'll skip on what that is, but it's the same thing that folks use to bet against the housing market, including Bill Ackman, back in the late 2000s. And so we're making a big, I think it was a $27 million bet in credit default swaps. Did that, ended up getting 100,000-fold increase on that bet, which is a wild increase in about 3 weeks, I think, or something like that. It was wild. It's wild. And so that bet ended up being worth like a couple $1 billion. That was one. The second, and interrupt me at any time if you want to comment on these. The second is in late March. So this is the other side of that 3 weeks. Blackman goes, whoo, stuff must have fallen a little too hard. And so then they made a big bet on the stock market. And we all know the stock market came back from bottoms there.
When it's easy to make a big bet on the stock market when you just say you got 1,000-time return,
like
on your
100,000. I think it was 100,000.
yeah, like that makes life a lot easier, right?
Yes,
You're like,
really
what am I gonna do with this extra $1 billion? I think I could deploy that capital, right?
When you're playing with the house money. Yeah, pretty much. Yeah. So that was the second. And then the third was, he said, interest rates have got to rise. And so this is, you fast forward like a year-ish, something like that. And Bill Ackman said, we're at a point where we're talking just like Skippy was back in the day. We keep saying transitory. You have so much pent-up demand. People are buying flights. Like this, it's about to hit big time. We have to raise interest rates, Fed. Called the Fed out, et cetera, et cetera. And so they made a bet that treasuries would end up spiking. That was the third. And so it was like a nice little trio.
It's amazing. The interest rate stuff is so frustrating to me. And I don't want to be a guy like this, but it's documented on the pod where you and I said interest rates are at historic lows. There's nowhere to go but ups. Owning long-term duration bonds is idiotic at this point in the game. There's literally no upside. Sorry, there's very little upside. You'd have to be
Yes.
betting on rates going negative, which doesn't make sense and is not good for anybody in the economy. And this, Doogles, like, this is Silicon Valley Bank. It's part of the story there too. They were buying long-term duration bonds yielding like 1 to 1.5%. Who thought that was a good idea to buy something that's 6 years, 10 years out, yielding 1.5%?
We're not there yet.
Oh,
We're not
man.
there yet. Slow your roll.
Oh,
Slow your
good for
roll.
Bill Ackman is all I got to say. All right, so here's where we are, Doogles. If I reach into my fishbowl, I think we're at housing. You ready to do this deep dive on housing?
No, I'm not yet. Can I do one more quick hit before we start? This will be real quick.
Okay.
This will be real quick. We promised not to talk about her for like about a month. I think it's been about a month and a half. So we're cool. Cathie Wood.
We met the quota.
Yeah,
but this is worthy of talking about.
This is worthy of talking about. So Cathie Wood's fund launched in 2014, been about 9 years. During that time period, investors in Cathie Wood's fund have lost almost $10 billion. $9.5 billion is what I'm seeing. How much have they collected in fees?
Isn't that 300 million?
$310 million. Okay, now we can go into housing.
Well, I want to let the listeners behind the curtain here. Text message from Doogles. If you lost your investors $10 billion, should you collect 300 million in fees? Skippy, no. That's how I feel about this.
Yeah, it's very straightforward.
It's not right. Like, it's not okay. And I'm not naive enough to think that any of the money is going back to those individuals. But there's part of the investment manager game that's all about AUM. And it's sad. Like, how does she honestly think maybe she doesn't, but does she think she earned that $300 million? I'm sure they just think of it as like, well, we have to pay for our research to do this.
Yeah, I mean, I'm sure she probably thinks about this in a couple different ways. I was trying to leave it at that, just to be clear. Remember, I was trying to leave it at the piece.
That. Yeah,
but she probably thinks about this as one. Yeah, it's a whole bunch of research, and this is a multi-decade bet on genius innovation. And so, how are you just going to measure me on the first 9 years? Now, at the end of 2020, she was like, "Yeah, you measure me at the end of this 1 year, or at the end of my first." Like 5 years, she was like, yeah, you measure me on this. Now she's saying, no, it's 10, 20 years out. We'll see. Only time will tell. If she weathers this and her stuff hits, more power to her. But right now, it doesn't look good.
You're right. We should leave it at that. But if I ever collect 300 million in fees on a 10 billion loss, will you come slap me or something? Throw me out of just like a 2-story window. I don't want to die. I just want to feel a little pain.
Well before 10 billion, the slap shall come.
Perfect. Good.
Yeah. All right, housing.
All right. You sent me this fascinating article. I'm pulling it up right now because I want to get the title right and give credit where it's due. It's called Good Reason at Substack, right? So Andre Cooper. Andre breaks down a current purchase decision. The place he uses is actually Littleton, Colorado. And basically comes up with this, what I think is a hypothetical example, right? Doogles, of a person buying right now and how it could play out, the buy versus rent decision based on where future home prices go.
Yep.
Fascinating piece, like really fun. If you're a housing market nerd, I'd recommend reading this. It will definitely be on our Substack.
Yeah, highly logical. And the title of this was "Maybe Treating Housing as an Investment Was a Colossal Society-Shattering Mistake." That's the title of the piece.
Thank you. We talk about housing a bunch on the show. And what we've talked about in the past couple of weeks is the affordability index, basically saying housing is as expensive as it has been maybe ever in the US, but certainly in the last 40 to 50 years.
Yep.
And where I go, I'm going to take a leap of faith from the article. So Doogles, if you want to go back and walk through the article, we can do that. But here's a hypothesis I've had for about a month that I've run by some of like my smart real estate investor friends. And I think I'm sold on it. I'm not sure that anyone else is sold on it right now. I think buying a house currently is almost like trading fixed income bonds, but people don't know that. And the reason I think that is because you are so dependent on where interest rates go that you're effectively stuck in riding the coattails of Jay Powell and team more than what's actually happening with housing and the supply and demand for housing. The reason I state that is because if we just take for a fact that housing affordability is at all-time lows, that means that the prices of homes are not increasing until housing becomes more affordable. The only way in the near term, and I'm even talking like a 5-year, maybe a 10-year near term here, that housing becomes significantly more affordable is if interest rates drop. If interest rates continue to climb and you're already at the peak of housing affordability, it doesn't matter if there's more people that would like to buy your home. Those people won't be able to buy your home at a price that's greater than the price you paid. It's just not physically possible because we know that wages are not going to take a 20% jump year over year. Like that's never happened and it's not going to happen. I guess the one case where that may happen is if inflation truly gets out of control and we become Venezuela. But let's put that on the table for the moment. Where I'm going with that hypothesis is I think it's really important to understand if you're buying rental property right now, or even if you're purchasing a family home, you are more susceptible to interest rate risk than I think you maybe ever have been, certainly ever have been in the past 20 years. And that really changes things. This article breaks down the fact that if someone buys a home right now, they would likely be better off renting if the value of that home doesn't appreciate. And what I'm saying is I don't see the value of that home appreciating without significant help from interest rate reductions that I don't see on the table right now. But I'm not going to forecast interest rates. That's impossible to do.
I'd push back only on one part. I think you're right overall. But I know you didn't mean this as straightforward as you were saying it, but the impossibility of this is what I push back on, because it would take, what I would say is what you said was true, unless there were some systemic changes like around policy and like government subsidization, right? Like there are ways to make it such that what you stated be different. But with the systems that we have today, I think you're absolutely right. And the example they provided in the article, which I agree, I think it was hypothetical example here, was someone named Alice. And when Alice ran the calculations, it came out such that the house would have to double in price roughly over the next 18 years in order for it to make sense. And you're right it's hard to imagine. Like it's really difficult to imagine that with the current systems that we have. Those could shift, but otherwise I fully agree.
I love your pushback there, because what happens with housing is like less rational than the stock market, because politicians love to get involved with the thought of, well, this is the American dream. And if it's almost like college tuition in a way, it's like, it doesn't matter. We never say, well, it's nonsensical for college tuition at a state university to cost $25,000 a year. We say, that's a fundamental right. So we're going to make non-recourse debt that you can go bankrupt for and still have to owe your college loans because we want people to be able to go to college. Well, that could happen in housing. There could be a public sector solution that allows home prices to continue to rise, even when like the simple math of it all says this is nonsensical. And people can't pay 50% of their wage to live. That you can't pay the bills if you do that.
And it was in the early episodes of this podcast, I think it even like on episodes 2, I think it started, we were discussing my decision to buy a house with my wife and the conversations we were having here, and Skippy and I were talking through some things to look at, etc. And the place for me personally as an investor, like as someone that thinks about things like this as an investor, the mental place I had to get to in order to buy the house is to not believe that the house was an investment. It was a financial investment. Like that's the place I had to get to. And right or wrong, I'm just like, like that's where my mindset was. Now I specify financial investment because of some of the stuff that's named in the article and some of the stuff we talked about, right? There's like an investment in family, an investment in like the city in which you live, like, right. There's like other stuff you can use the word investment for. But so long as I was thinking this is a financial investment, I was like, I would do a lot of other stuff with this cash now. Right. And so I couldn't view it as an investment, but there were there were a couple straight quotes I want to take from this article. Not going to walk top to bottom, but a couple straight quotes that I just thought were kind of magical. One is, when you invest in a company, you expect the stock price to rise because the company becomes more productive. When you invest in a home, you expect the price to rise because shrugs, it just does. I know there's a hyperbolic nature to it. I love that quote.
There's my dad's family is from Ohio, right? And that was 50, 60 years ago when he was growing up. That was like boomtown. The factories are still going. It's a great place to be. And we relocated to Colorado. The Colorado real estate market has basically been like the mini California real estate market, where you can buy anything, it goes up in value. And the people I talk to in real estate, not all of them, but a lot of them go, yeah, the price goes up because it does. And I go, yeah, well, look at all these markets in Ohio where the home is worth 25% of what it used to be worth. And there's literally vacant. I mean, not every market is like that. It's really important to understand that. And that I think a lot of, I shouldn't say that. That's too strong. Some real estate investors basically have no clue what they're doing, in my opinion. And they end up in a good market, and it's luck disguised as skill. There's a lot of really good ones out there, but some of them just ride the coattails of a hot market and never understand why.
And part of the mindset you're talking about is what led to the boom and bust of the housing market, 15 years ago. There was this belief that, well, some people just like knew what they were doing and wrote and from the corporate side knew what they were doing and pushed this thing to limits.
Yeah.
But if you look at from the other side of it, consumer side, et cetera, it was everyone pays their mortgages and housing always goes up. So like, if you believe those things, then no matter what we do, it's just going to go up and to the right. So keep betting, right? It's a mindset when you take it to the extreme and have leverage on top of derivatives that becomes really, really dangerous. One other quote here.
Yeah.
So this kind of piggybacks off the last one. Moreover, houses are pretty much the only physical good that are expected to, 1, appreciate in value, and 2, be used all the time. And they go on to give examples of playing what they declare as baseball hockey inside your house, people like jumping on your furniture, scuffing up the walls. It's like all this stuff that you do to depreciate any other asset is expected to increase the value of the home. And the whole thing wraps because it's saying it's not really about the house. It's about like the location and scarcity and all this other stuff is what it leads to. It's not the house itself. That's what it kind of goes on to. But I thought that was a very interesting little quote.
Well, I like that frame. And I want to be clear. I don't agree with 100% of everything in this article, but I did find it a fascinating and very fun read.
Yeah.
But I think there's a breakdown of like, you buy the new car for $50K, you drive it off the lot, it's worth 40, and you fully expect that 5 years later, if you're going to sell the thing, it's worth 20, right? Like that's just how people think about cars and a lot of other assets. And then he goes, yeah, you're playing baseball in this house and you expect it to double in value every 10 years every 15 years. Like when people think of housing only as an investment, and I'm trying to be careful with my words here, let's say like your main residence, not a rental home, they go, yeah, like I'm not gonna have to put in new carpet or patch up the walls or do this. It's just gonna become more valuable. Turns out home ownership is very, very expensive.
Yes. Well, how did I describe it? Do you remember?
It's not an investment.
That and a lifetime of inconvenience. That is my description. Okay, should we give the people what they want?
I think we should.
Okay. All right. Let's talk Silicon Valley Bank. And if it's cool with you, I'm going to cede the floor over to you because you are to give like the context background, you are the banking guru of the podcast.
Happy to do that. So yes, I spent more than a decade in banking. I also on a daily basis help companies deploy capital and manage bank relationships for them. So this is in my wheelhouse. I'm going to try and make it so it's not too nerdy, Doogles. I want to talk almost disconnect from some of the real pain. And we always try and do that on the pod, whether it's layoffs or anything else. Like, there are real people impacted. There are companies that can't make payroll because Silicon Valley Bank was managing their funds. There's ramifications in the crypto space, like we talked about earlier. So let's have everyone grab a virtual beer, and we're just going to talk about some of the fascinating nature of what happened, and give people a refresher on banking runs, which are a part of life and always will be a part of life. Doogles, at last two holiday seasons, I've been talking about the remake of It's a Wonderful Life. This might actually be I might be able to pull something with Silicon Valley Bank to update that beautiful, kind movie about having great friends to support you. All right. The main thing, well, okay. And then I'm convinced I'm actually living in the Truman Show. Right as Silicon Valley Bank is happening, someone pops up with a Jim Cramer clip. I swear this seems like it's got to be generated by artificial intelligence, because he like checks every box of the things you would not say, or you would hope you never said, for a bank that's going bust. It was one of his year-end stocks of the biggest winners. So the biggest winners so far in 2022. I think this was like
2023.
2023. This is in the past 3 weeks. And he gives a little blurb on how great the business model is and how stable it is and how strong the bank is. Jim Cramer, man. Okay. Here is a lot of what's happened in the Silicon Valley Bank space. I want to start with some high-level definitions that are valuable here. This is from the net interest article that we'll put on the Substack. Banks get assets, Doogles, and they put them into two. When they purchase assets, they put them into two buckets, and these are typically balancing out their liabilities, which are their deposits. So one of the buckets is held to maturity, and another is available for sale. The reason they put them in those two buckets is because it's important, and this goes almost to fixed income trading. So I want you to sanity check to make sure I do a good definition of this, right? So let's say I have $10 billion in deposits coming to my bank. And let's say I can only deploy $5 billion of that with lending that I feel is safe and I can make a decent return on. That means I'm sitting on $5 billion worth of cash that I got to do something with. And typically I'm going to go buy something. Could be like treasuries, could be mortgage-backed securities, could be something that is deemed very safe, you would hope, because these are banks, to try and make a return on those funds so I can pay interest to my depositors. Why is it important to pay interest to my depositors? Because if I don't do that, they go elsewhere. And Doogles, I'll tell you, one of the ramifications of this failure for the average consumer is you are going to see interest rates go up across the board. Because on this show, for the past 6 months, we've been highlighting how you can get a 4% interest rate in lots of places that aren't your bank. And so people are pulling out funds. When people pull out funds, the banks have to give them their money back. And sometimes that's incredibly onerous. That's what started for Silicon Valley Bank here. So
I'm going to interrupt just to give a couple additional definitions, maybe, of two things you mentioned: available
Please.
for sale and held to maturity, and the importance of those buckets. You're going to go into ramifications, assume here. So on the held to maturity, why that's important, and we've talked about this with bonds in the past. If you buy a bond, the bond has a certain duration, which means the length of time until that bond matures. Let's give a simple example. If I buy a 5-year bond, when I buy it on day one and hold it for 5 years, it is going to pay me whatever the coupon, that's the interest rate payments, right? It's going to pay me whatever that is on whatever the frequency of the bond is until it matures. And then I get the principal, the amount of the value of the bond back at the end. Mm-hmm. Between now and that maturity date, though, interest rates can change. And as we've discussed, bond prices are inversely related to interest rate movements. And so if interest rates go up, the price of my bond goes down. And so the bond, while I'm holding it, is going to fluctuate up and down based on interest rates. But if I hold it to maturity, that doesn't matter because I just get back the value of the bond at the end. So that's hold to maturity.
Well, and available for sale is the opposite. Available for sale is going to be mark to market. So the bond holding that I have, to keep it simple, if I bought at a 1% rate and rates go to 4%, that the value of that bond, you talk to these things in hundreds, is going to go from 100, which would be par, to 95, something less than 100, because the out in the space, you can go buy the next version of that bond and get a higher return. So the value of the previous version of the bond at a lower interest rate is worth less as a version apart. We're fairly deep in the weeds, but it's important. So I'm just flabbergasted, and I'm sure there's some reason to it that I can't comprehend, but the average maturity of bond purchases for SVB was 6.2 years. So we just talked historically low interest rates coming into 2020, 2021. You're a bank, you're in that situation where you have 10 billion worth of deposits, you have 5 billion that's easily deployable, and you can make a nice return. For simplicity's sake, this is not what Silicon Valley Bank did, but for most banks, call those mortgages. Like, you have people lining up that want to buy homes. You can deploy 5 billion of that and charge them a 6% interest rate or whatever. Like, the finances work out because you make a 6% return from those individuals, and you only pass down a percent or two to your depositors. That spread is how the bank makes money. Some of those people that buy your mortgages default on their loans. That's part of the equation. You know that's going to happen. Everything works out. It's the $5 billion that you can't deploy that you go buy these bonds. I can imagine buying 3 months bonds, 6 months bonds, in some cases, even like a year. I cannot imagine buying an average maturity, and these were mortgage-backed securities, it sounds like, of 6.2 years. Because what is bound to happen if you're sitting on rates in the 1% range? They're going to go up. And what happens to those held to maturity assets, Doogles, is you get upside down, and you get upside down very quickly, because you have this 6-year duration yielding 1.5%, when all of a sudden the going rate is 4.5% to 5% for that product. So the value of that loan is significantly, or the value of that bond, significantly less. Now, you planned to hold that for the full 6-year period, but your depositors start freaking out because of a poorly issued press release and some other things here, cutting to the chase. And they start pulling that $5 billion out. And you go, we don't have, all our money's tied up. We have money 6 years from now. We don't have money right now. Then you get into a situation where you have no good choices. This is exactly what happened this week. And you can either take those held to maturity assets and sell them at a steep loss based on the current market value. But if you do that with any one of those bonds, you have to mark to market the entire portfolio. So that might be a 30% loss. That might be more. And actually, I have those numbers, but not in front of me at the moment. So as soon as you do that, you create more concern in the market, which leads to more VCs saying, get your money out of Silicon Valley Bank as soon as possible. Classic bank run. You get the cyclical loop, and you don't have a bank anymore.
You're betting on, in order to have an average maturity like they had, you're betting on two things to be true, I think. You have to believe that two things are true, and you're betting on them. Like, you're betting your company on them. One is that there won't be a material and fast decline in your deposits, and or that it will be very easy for you to raise capital in the case that there is. Like, those are kind of the two things that you're betting on. There's a simple solution I don't understand why they didn't do. Just write the checks for the people taking out the money, post dated 6 years.
You got jokes, huh? There's no simple solutions here, but it's unfortunate, really unfortunate, that it almost ended up as gambling. Like, the bank wasn't trying to gamble.
No.
But it almost ended up that way. And they missed the interest rate risk. They missed. I read another breakdown that talks about the European Union's banking commission doing more regulatory testing on interest rate shocks, basically. Now, some people are trying to call this an interest rate shock. This is where I continue to be so frustrated. It's not, Doogles. Jay Powell came up to the microphone once a month for the past 12 months and said, we are raising interest rates. We are raising interest rates by this much. Here's our target. Like, how you could not see this coming. It was as telegraphed as you could ever get. So the other thing I need to mention, and I'm sorry because like this is just so fascinating, I'm talking too much, but the other challenge with Silicon Valley Bank is they had an incredibly concentrated pool of depositors, users, company types.
Yep.
It's the bank for startups and venture. It's the place. So Roku had $497 million in deposits there. Roblox had 5% of $3 billion, their total cash holdings at Silicon Valley Bank. A lot of VCs or managing partners told their whole portfolio of companies, go work with Silicon Valley Bank. And so then it's not like, all banks deal with one company or two companies or industry going through tough times, but typically they have other deposits from other companies, other sectors that balance those out. Silicon Valley Bank doesn't appear to have that.
And I'm going to give the silver lining here in my eyes.
Yeah.
The silver lining is that it's easy. Let me back up for a second. I think it's easy for folks like outside in at the macro level to start thinking about Lehman, Bear Stearns, and similar type of situations. Washington Mutual, which is the largest bank failing, where Silicon Valley Bank is the second history of the country from 15 years ago. It's easy. One big difference, which leads to my silver lining here, is that back then, the main reason for the failure of those institutions was they were holding a heap of junk. And what was happening was the market having the realization or just the decision to say this junk is junk and it's worthless. And so you have a whole bunch of your portfolio that's worthless. Here, in accordance to what you're saying, they hold quality, like high quality assets. They just can't have that money for 6 years. And to your point you're bringing up right now, a cousin of the point you're bringing up right now is when you have all of those assets concentrated in one firm, as highly concentrated within that firm, even that it is, like it was something like 80% of their of the securities were held to maturity or something. It was really large. I got that percentage wrong, but it's like really big. That's the problem. But with the FDIC, when they go either the FDIC or a big bank that buys them, which might happen this weekend, like this weekend, a big bank, I would say, I'm not a predictor, but the most likely scenario is that a big bank probably buys them. But
if I was a big bank, there's probably a deal to be had. Absolutely. Like
I would guess Goldman.
I'd
guess Goldman. That'd be my guess.
See, you know who should buy them, Doogles? This is completely speculative. It's Wells Fargo. You know why? Because Wells Fargo needs some positive PR.
And this would be that? Are you hold on just to be clear?
No, listen.
Are they searching for scandals? Is Wells Fargo the Cowboys or the Cleveland Browns?
No, Wells Fargo can ride in their little horse and carriage. Seriously, they should have to have money in a horse and carriage. Drive it down from San Francisco to Santa Clara and throw some money on the line. And no, they could save the day here.
It actually, we'll get back to the serious stuff in a second here, but you're onto something. But you know who should, on Wells Fargo behalf, ride in the horse and carriage?
Who?
I forget his name, but it's like something Mac, the dude that was with the wheelbarrow down in Texas.
Oh, Mattress Mac.
Mattress Mac. Yeah, I feel like he should ride in on the Wells Fargo trolley, horse and trolley. Anyway, okay. No, but in all seriousness, like the assets are high quality. And so this it's not like there aren't dollars that exist. They just don't exist now. And so if you can make these assets as a part of a diversified portfolio elsewhere or many elsewheres, like the money's there. I think that is like a big difference. The money is there. And so Push
I
back.
want to hammer home that point with my opinion. It's not Washington Mutual. Like they are in a much better position. But at the same point, holding a 6-year term that yields 1.5% is not ever going to get to par because the interest rates are at 5%. So there are losses to be had here. I don't think they're massive losses. I think the large majority of the people and companies that banked with Silicon Valley Bank are going to get, I don't know, 90% of their funds back, hopefully more. That, and the reason, hopefully 100%. But what's so interesting about the concentrated portfolio at Silicon Valley Bank is only 2.7% of their deposits were less than $250,000, which is the FDIC insurance range. So there's 97% that is exposed, meaning it's not guaranteed by the government. To your point, there's high quality assets behind those. So hopefully this doesn't end up being a big deal. And I think I'm going to call Wells Fargo. They need to ride in and save the day here.
Yeah. And one last statement, I don't mean for this to be political, but it kind of inherently is this is one of those situations where some folks in the government are going to use it as if it is a Washington Mutual, et cetera, whatever it might be, as a case to say, government, why are you stepping in, et cetera, et cetera. And they want to use this as a point against like executives being bailed out or making money. But to the point, I just want to ride off what you were just saying.
Yeah.
Silicon Valley Bank, its average holdings, like deposits, were about $4 million. I can't remember the exact amount. It's about $4 million. And so what you're talking about, going back to what you mentioned before, if you have average of $4 million, you're talking about a small entity, like in the startup world, and organizations that are thinking about either the payroll that's about to happen or
Yes.
the next payroll that's happening, right? And if you're that small of a company, this is material. So we're not talking about the executives here solely. Like we're talking about, like, I'm going to go back to quality assets, cash in a lot of circumstances that small enterprises need in order to pay their folks. So back up off. That's what I would say.
Yeah, there's a startup bank called Mercury, which I've worked with in the past. And they sent an email Friday that simply said, like, we've been overwhelmed by demand and are working all weekend to open new accounts. And I was like, of course you have it. But it was a funny update. Okay, we need to talk about politics. I've decided on this show, I'm not going to name any specific politician because there are people on both sides of the aisle that really frustrated me. There is a congressman or a representative from California.
This is the transition. Or are we still on?
Yeah.
Okay.
Well,
right.
no, this is still related, to be honest.
Okay.
It said, I'm working with my California colleagues to address the Silicon Valley Bank crisis. We must ensure that all deposits exceeding the FDIC 250,000 limit are honored. Banking is about confidence. If depositors lose confidence on the safety of their deposits, then we are in trouble. Jason Swag, my boy, tweets this and says, if you're looking for a perverse incentive for banks to become really reckless, you're on the right track. I just want to hammer Jason's point home there. If you just say, in all circumstances, regardless of how reckless the bank is, and I want to emphasize, we're not saying that SVB has been incredibly reckless here. They just had a confluence of events that's poor, and it had a few bad decisions in there. That's when you just say, oh, the government insures everything. No, then there's no skin in the game for the bank to actually act rationally. So this is, it's funny because we didn't talk about this in the pre-show meeting, but this is where I get frustrated with politicians because they consistently show that they don't understand banking, finance, investing.
Yes.
Right. And you need confidence in the banking system. Absolutely. The $250,000 limit is there for a reason, because for most of your mom and pops, that's going to make them sleep at night.
Yep. Corporations
and others have more responsibility to think about some of these systematic risk and manage to those things. And banks certainly do. That's basically the value you add as a bank, is giving people peace of mind that their money is safe with you. So I just wanted to spotlight Jason's point.
One last point I want to bring up. I'm probably going to state this too strongly, and I'd love to get your reaction to it. In many ways, Silicon Valley Bank was fine. I say that meaning if you look at the detail of what occurred this week, you effectively had a situation, right, where they put themselves in this situation. So I don't mean like what they did was like all that stuff was fine, but you had a situation where they were having deposits come out in order to cover those. To hit on your other point, they didn't have enough available for sale securities, so they would have to sell from their bond portfolio in order to do that. They knew that if they were going to sell from their bond portfolio, the whole portfolio would have to be marked to market. If they did that, so they would have had the money, is my point. Like they would have had the money, but if they did that, then they wouldn't have been able to meet their regulatory ratios. So they went, okay, so we can't do that. So what we should do is raise capital. And there was the happenstance, the bad luck and happenstance. There's also intentional stuff that happened in here. But the bad luck and happenstance that happened on the same day that the whole Silvergate nonsense occurred. And so like the faith in the system, like that day was not good. But they were trying to get like a couple $2 billion. Like it wasn't for a bank of this size. Like eventually,
was it the 14th largest bank in the U.S.?
Yeah, exactly.
I mean,
it might have caught up to them eventually anyway, right? Because of all the stuff that you named, which is real. But it was, to me, it was like the bank could have just been fine.
Well, banking's all about confidence. So seriously, watch It's a Wonderful Life, people. Like the guy, the savings and loan, George Bailey has the money. He just has the money tied up in other places, and they're good investments. But when people freak out, you only have so much in your vault. So this is how bank runs happen. Bank runs will continue to happen. It's really hard to articulate it, Doogles. I mean, I think they were fine, but they were fine until they weren't. And all that took is 36 hours, right? And it's so funny because it's almost like the PR team or the investor relations team tripped over themselves a couple times, and then we're at a really fragile place in the financial psyche. You're totally right that if they would have grabbed $2 billion in a different way, or if the press release would have had a narrative to it rather than just I mean, I don't know if you've read the press release, but it's pretty opaque, and I think that caused panic. And then but man, 4 days ago they were talking about how they're one of the best places to work in America, and the CEO was fielding questions on conference calls about how he distresses and talking about how he loves to ride his road bike in Northern California. Like there was no sign of this.
That was Tuesday
ago. Yeah. And Tuesday. Now they don't exist effectively.
Yeah. It really is wild. And to all the points you're bringing up, like bank is about confidence. They set up their infrastructure such that it was questionable. Like it was very questionable looking from the outside in, and from the inside out probably as well as questionable. And so their infrastructure wasn't very sturdy. And then, a couple hits of bad luck and a couple bad decisions and executions, and there we are. It's quite fascinating. We've beaten this one enough, although we could probably talk about this for hours because there's a lot of different like tributaries, but I think we beat it up enough.
Yeah, we'll call it, we'll wrap it, but I really feel like I've only covered, I don't know, 15% of the material that I read. But let's wrap on a positive note with a continuation of the everything bubble. The WWE, which is World Wrestling Entertainment, has filed some paperwork with somebody. I think they're working with PwC or someone else to try and ensure security of their plots, because if you didn't know, it's all scripted, and they basically, it's like a TV show, right? They tell people exactly what to do and when to do it, but they'd like to encourage gambling on the outcomes of their matches. So, I mean, Doogles, I thought we were kind of done with this. I thought most of the bubbles had popped, but apparently the gambling bubble is still gaining steam.
I've got an idea. Imagine this. It involves what we talked about earlier, body doubling. Imagine people watching you, betting on and watching WWE wrestling.
And how you react is what they can bet on or something.
No, they're just watching you.
They're
bet.
just watching.
they're just watching.
No, I want another layer of betting.
thinking.
I want like, is he gonna throw his water bottle or not if he loses the bet?
Exactly. A friend of mine and I, this reminded me of a short story. A friend of mine and I, maybe about 10 years ago, something like that, we were out just hanging out at a bar, and we were watching this boxing match, and we were rooting for different people in the boxing match, and we were like, we're gonna throw down a bet.
Yeah.
So we throw down a bet. Boxing match ends, and then we decide to like look up the match because there was something, I don't know, there's a question that we had, and realized this match happened like a month ago.
I've been there too. There was we were at a pub in Europe, and there was a sporting event going on that was like the championship game. We were disconnected from it. It had happened the day before, and we got so into this thing, man. Like exact same sort of thing. But everyone in the pub was looking at us like we were stupid, and we didn't figure out why until 3 hours later. Google's scary that way.
Thank you, everybody. Appreciate you. SkippyDoogles.com is our one-stop shop. And if you got listener mail, skippydoogles@gmail.com. Thanks for listening.
Thanks, guys.